This is Capital Ideas TV. Coming up, all-star performers featuring the CEOs of Namaste Technologies, Drone Delivery Canada, Canada Jetlines, and more. Hello and welcome to this special all-star edition of Capital Ideas TV. I'm Mark Bunting. We started Capital Ideas TV in the spring of last year with the same mission that we have for our weekly investment newsletter, and that is to give investors access to the best investment ideas. Our weekly show has now featured the chief executives of more than 140 companies, many of them early stage, innovative, and on the cusp of strong growth. Now, some of the stocks of these firms have done very well since the CEO's appearance. In fact, the shares of companies that have been featured on the program are higher by a net 25% as of St. Patrick's Day, so reason to celebrate. That's since the CEOs were on the program. Now here's a look at our top 7 performing ideas and one laggard that still has a lot of promise. Drone Delivery Canada is based in Vaughan, outside of Toronto. It's up more than 350% since we featured CEO Tony Benedetto in early July. Greenhouse operator Village Farms is making an aggressive push in the cannabis space and is higher by more than 250% since we talked to CEO Michael DeGilio in mid-September. Aphria, another cannabis producer that has been in the news a lot lately given its buying and selling spree, is higher by 170% since our special full episode with CEO Vic Neufeld in late July. Airline startup Canada Jetlines, based out of Vancouver, has been a high flyer as well, soaring 160% since we spoke with Stan Gadick back in September. Another Vancouver company, Legend Power Systems, which makes voltage reduction and management technology, has been a star performer as well after we sat down with CEO Randy Buckamer in June. Namaste Technologies, meanwhile, is the world's largest seller of vaporizers. It's just received its cannabis sales license from Health Canada. The company's shares have more than doubled since we talked to Sean Dollinger in late November. U.S. Cobalt turned out to be one of those nice surprises as it was recently bought by First Cobalt for more than $150 million, giving the stock a cool 166% return since our chat with the CEO. And one laggard that still has traction is bus maker Grande West Transportation, whose shares were peaking when we interviewed the former CEO Will Traynor. The stock has been consolidating since then. We'll have more on the changes at Bus later on. Let's take a closer look at these winners and why investors who got in after we highlighted these companies have at least doubled their money since then. We'll start with Namaste Technologies, in part because we visited the company's sparkling new Canmart facility recently to interview CEO Sean Dollinger. Namaste found its niche selling vaporizers and other smoking accessories through 32 e-commerce sites in 20 countries, but it continues to branch out and strike deals. Namaste will soon expand to cannabis sales after buying Canmart about a year ago. Canmart recently received its license to sell cannabis from Health Canada. The company also boasts a vast database of cannabis customers as a value proposition. Dollinger describes the importance of Canmart to the company's strategy.
Well, with this facility, it allows us to add on a whole new product line, the consumable, cannabis, hopefully eventually edibles, as Health Canada allows those different avenues to take place. Obviously, we'll be in the front line now, being an LP. So, here we are today, and I'm extremely proud of what we've been able to accomplish here.
Is there a thought that down the road, maybe somebody else runs this for you and you handle the marketing and the delivery and so on?
As you know, our specialty is e-commerce, marketing, getting customers to our website, offering them an unbelievable selection. For now, we'll definitely be here getting this up and running, but down the line, we'd love to be able to have the avenue of being able to have multiple centers, just like this one, that we don't necessarily need to own. Again, Health Canada will need to approve different methods of doing this, but where we could use these facilities to distribute cannabis across Canada.
There's so much competition in medical cannabis, as you know, so how do you appeal to medical practitioners? How do you appeal to customers to say that, hey, you want to come to Canmart, Namaste's Canmart, for what you need?
We make it really easy, the whole process. Vaporizers, there's a lot of competing websites out there, but we've never backed down from the competitive market. That's what we specialize in. We offer an unbelievable experience. Our overhead is extremely low. You're sitting here in our brand new facility. It's about 5,000 square feet, but our overhead, the way that we've set up, the technology that you see around the room, it allows for a much quicker, easier process.
Namaste's stock took off and more than doubled since we first spoke to Dollinger in late November. There's been a lot of volatility in the cannabis sector, and Namaste has not been sheltered from that despite its unique business model. However, investors who've been in the stock for about a year have seen their shares soar by more than 600%. Namaste is also striking international partnerships to boost its presence in the global cannabis sector. The company says its focus this year is on establishing Namaste MD, a telemedicine portal designed to connect doctors with medical marijuana patients. Capital Ideas TV, meanwhile, will soon be launching a weekly live streaming partnership with Namaste Technologies, where Sean will be updating us on the company's progress and giving his opinions on developments in the sector. So stay tuned for that.
Right now you walk inside a truck and you see multiple devices. You see a fleet management device, you get two-way radio, black box, tablet of some sort, front camera, $6,000 to $10,000 worth of equipment. We're shrinking down to less than $1,000 in one device. The change in the cabin is just dramatic. It's just much, much safer for the truck driver to be able to use one device. Really what we're doing is we're creating a new environment and a new technology that has not been seen to date in the market.
We've been following Drone Delivery Canada for well over a year and interviewed the CEO twice as the company hones in on its goal to commercialize its delivery by drone service in rural and remote areas. The company recently started development of its newest cargo delivery drone called the Condor, which can lift about 400 pounds and fly as far as about 150 kilometers. That makes it ideal for moving bulk cargo. The company says the Condor will have a considerably larger payload compared to its smaller Raven and Sparrow drones, which we're looking at here. Drone Delivery is eyeing markets here at home in Canada, in particular in remote northern communities, as well as opportunities abroad. Drone Delivery Canada's shares hit an all-time high of $226 a share in January, shortly after debuting on the TSX Venture Exchange in December. The shares have drifted lower a bit since then, even as the company continues to churn out good news. The markets have been pretty volatile, as you likely have noticed lately. In February, Drone Delivery received a compliance certificate from the Canadian federal government. The Transport Canada designation is required before any company can apply to fly beyond so-called line-of-sight operations. It allows the company to launch commercial pilot programs in remote communities in Northern Ontario. Here's a recap of an interview we did with CEO Tony Benedetto about how the right partners are helping attract more investors to the company.
As we continue to move forward towards commercializing our platform, we're looking to assemble the right kind of partners in different kind of verticals, whether we're talking about retailers or distributors such as a Wolseley or healthcare providers such as Texas. It's really about finding key players in different niches of the market where we can bring our technology to fruition.
And these kinds of arrangements, let's say with Wolseley, are you planning on depot to depot or warehouse to warehouse? That's what they're looking to do?
They're looking to start in a depot to depot methodology. The starting point is going to be Northern Canada, and then slowly as we gather more data and execute missions, then we're going to start looking with the regulator, trying to move the technology closer to more of a suburban and then urbanized area after the fact.
Something else that you've been up to is going to the United States. Every now and then you have a U.S. listing now and an over-the-counter listing. So what's the importance of that, and what kind of reaction are you getting from U.S. investors?
So we started getting a lot of interaction based out of U.S. customers out of the U.S. And we said potentially there's a big market for us here. So we went to the U.S., started presenting our technology to the market just as an educational process. And we had very strong acceptance. There's no selling. There's a buy-in. They understand that this technology is coming. And whether we're talking about funds or high net worth or retail type investors, there's a very strong appetite. So we're slowly developing this market and just putting more eyeballs on the company.
So you have first mover advantage in Canada. Do you have the same thing in the US, or are there similar companies to you there?
We have a very unique solution both in Canada and the US. our strategy has always been focused on the software and the systems versus the hardware. And what we're slowly starting to see is that we have a real advantage in North America, if not globally, based on the technology we've been able to assemble and test within the Canadian geography.
You recently raised about $15 million. What are you going to use that for?
So part of the $50 million is really to assemble a small testing team to explore opportunities outside of Canada. One of the markets is the US. The market, we believe, is the right place to go, and simply take our technology and just execute it in a different geography.
Analysts like drone delivery stock. GMP recently initiated coverage with a buy rating and a price target of $225 a share. Analyst Deepak Kashal says Drone Delivery Canada has a first mover advantage in its market and is solving the most important challenges in the industry by focusing on building a system to remotely pilot drone operations at scale. I talked to Benedetto recently, and here's what he had to say about the importance of this year for the company. He said, "We're poised for big things in 2018, and we haven't missed a milestone yet."
We feel like we're the wave of the future in terms of how people test for things. We anticipate being the first sample-to-answer instrument that can process up to 22 pathogens at a time. Whatever you want to test for, you can do it on your own. You don't have to ship it away to a lab. You don't have to have an expensive microbiologist. It's something you can do on site. You collect that sample, you input it into the machine, you hit a button, an hour later you get the result you're looking for.
Village Farms is not your average greenhouse operator. The company has been on our radar long before the stock took off early last fall. The tomato grower has moved into cannabis production in a big way, ahead of full legalization of marijuana in Canada this summer sometime. Village Farms has a 50-50 joint venture with fellow cannabis player Emerald Health Therapeutics, which is called Pure Sun Farms. On March 5th, Village Farms announced it had received a cannabis cultivation license and expects to get a sales license by Canada Day. Now, we've interviewed Village Farms CEO twice, starting in September of 2017. The stock took off shortly afterward and is up more than 250% since. The shares hit a high of nearly $10 in early January. Here's what CEO Michael DeGilio said in one of our conversations about the company's valuation.
Through telling the story and people understanding the fundamentals of what we offer in the ability to convert existing high-tech greenhouses, not develop them, not build them, but convert them at a much lower cost. And the critical mass and knowledge and talent that we have in our company that we can immediately access to grow cannabis in existing facilities. So we can move very fast to the market, and I think that story is resonating very well with others. Now, the stock has increased, but I mean, when you compare our stock price even today, if you just looked at the other LPs on a cost per gram, just on their funded capacity, they're trading at an average of about $12 a gram, and we're still $1.60. So even though our stock is ramped up, there's still a huge differential in the valuations compared to the 8 largest public LPs out there.
So there's lots of room to run potentially with the stock.
Absolutely. I mean, we're going to be one of the largest cannabis producers going forward, and that's just with the smallest conversion, the smallest greenhouse conversion to start. We have options to convert others too.
Echelon Wealth Partners started coverage of Village Farms in December with a speculative buy rating and an $8.75 price target. Analyst Russell Stanley has moved that target to 13, and he and other analysts say the stock could move higher around earnings in early April, when management is expected to provide an update on the Pure Sun Farms joint venture. I talked to DeGilio recently about the company's prospects for the rest of this year, and here's what he had to say. 2018 will continue to be a busy one for Pure Sun Farms as it begins commercial production in the first 250,000 square foot quadrant of the 1.1 million square foot Delta 3 greenhouse, continues the conversions of the 3 quadrants at Delta 3, and focuses on development of its marketing and distribution strategy as a vertically integrated supplier to the Canadian cannabis market.
So we finance top-tier companies in the medical cannabis industry in exchange for a royalty. I love the royalty model. I think it works perfectly for this industry at this time. Debt is largely not available in the US, and equity can be massively dilutive. And the reality is every company in California and most states right now is a startup company. So we offer a very attractive, either a complement or an attractive alternative to debt or equity, which really aligns our financial interests with the interests of the people that we invest in. So when they're successful, we're successful, and the more successful they are, the more successful we are.
Aphria is a cannabis producer with a lot going on, especially since we aired a special episode with CEO Vic Neufeld in late July. Aphria is considered one of the lowest cost producers in Canada and has also been in the headlines for its ongoing M&A activity. Afria's most recent acquisition was of Nuvera, which was also recently targeted by a short seller. A number of Aphria insiders did not disclose they owned shares in Nuvera when Aphria made a bid for the company, but Aphria says the stakes were not significant enough to require disclosure. Here are some highlights from our chat with Neufeld about Afria's low-cost structure and how he disagrees with how a number of his peers account for costs.
I've gone to the exchange, I've gone to PwC, our auditors, etc. It's just not right. I used to be a chartered accountant, a partner at Ernst & Young, so my training, my first career, so to speak, before Jameson Vitamins, I'm disciplined in terms of the debits and the credits. And whatever touches a product, cost-wise, before you sell it, should be embedded in cost of goods sold. So there are a lot of costs that are properly contained in many publicly listed licensed producers. But when you eliminate QA and QC costs, indirect labor, indirect overhead, and throw it below the line, below gross profit, not in cost of goods sold, that has a positive impact on lowering your cost per gram. Everybody wants to get close to my cost in a greenhouse. They're not capable of doing it indoor. So they're using arguments or interpretations of accounting policies. Quarter after quarter, I'm looking at saying it's not right. Their margins are so low that they're not capturing the soundbite cash cost per gram. So what we decided to do this quarter is use their definition. So the cash cost per our usual definition is $1.11, a huge reduction from Q3 and and it will go lower. But if I looked at what others are doing in their definition and replicating it, we're at 79 cents a gram cash cost. That is unheard of. So anybody that wants to tell you that they can buy from Uruguay at 50 cents and shipping and all that, God love them for it. If you do it what we're doing, if you have the greenhouse technology, the processes, the techniques, the mindset of how to grow agriculture in a greenhouse, you can replicate what I have in Leamington. But at the end of the day, enough was enough, so we came out with what we called our cost and other competitors' costs.
Like most cannabis stocks, Aphria shares have been volatile over the past year, trading between a low of $4.55 last spring and $24.75 in January this year. The stock is now around $13, which is up about 170% since we first sat down with Neufeld. Analysts are still bullish on Aphria, with 7 out of 8 giving it a buy recommendation and 1 a hold. The average target price is $23.20. If their forecasts come true, that's a $10 boost from where it sits today. Shares of discount airline Canada Jetlines hit some turbulence earlier this month. The carrier has had some trouble finding planes, given stiff competition in the sector, and that means its launch, set for June, has been delayed. Still, the shares have caught a tailwind since that March 14th announcement, and investors that bought around the time we featured the company and its straight-shooting CEO Stan Gaedic back in September are still well ahead, with the stock up 160% since then. Now here's a clip from our conversation with Gaedic on the Vancouver-based company's low-cost business model and why he feels it has room in the Canadian skies.
And I can make the statement that we're going to have the lowest costs because we've done a very comprehensive job in terms of modeling our financial projections over the next 5 years. So I know what our fleet plan is, I know what our level of operations are, I know our revenues and our expenses. And our costs are going to be about 9.5 cents per available seat mile. When we look at the other carriers, WestJet's costs, based on their 2016 numbers, are 12.5 cents. Spirit in the United States, when we adjust theirs on a Canadian currency basis, their costs are 9.9, Frontier's 10.2, Allegiant 10.8 cents. So right out of the box, we're going to have much lower fares than the other guys. Air Canada, I didn't even model. Their costs are off the charts. But they're a much more complex airline than we are.
Right. Now, you mentioned a bunch of low-cost airlines there. Do you look at them to see what they're doing right and wrong? Do you look at the Ryanairs and EasyJets of the world in Europe to come up with your model?
Absolutely we do. And in fact, I want to mention that on our board, we have 2 former executives of EasyJet, Flybe, and Wizz, which are 3 ultra-low-cost carriers in Europe. Saad Hamad was Chief Commercial Officer at EasyJet. John Stevenson was Chief Commercial Officer at Wizz, which is the Hungarian Eastern European ultra-low-cost carrier. And then Saad went on as CEO of Flybe. So we have excellent expertise on the board, and this is a working board. Our board members put a lot of input into the development of this business plan, as well as reviewing the financial projections that we have put together. And so the answer to your question is absolutely. We have to study and identify best practices among the ultra-low-cost carriers of the world. Why? Because it's a very demanding niche in terms of a business model. You have to have absolute discipline to adhere to the lowest possible costs. It's hard to get low costs. It's hard to maintain high productivity. It's not something that you can just achieve and then you're done. It has to be worked at every single day. And so that mindset has to be pervasive throughout the company. And it's got to emanate from the top and through every employee of that organization.
So while shares of Canada Jetlines may have dropped from their high around 87 cents earlier in March, longer-term investors are still celebrating. As you can see in this one-year chart, the stock has been on a steady climb, up 160% over the past 12 months, as mentioned. Canada Jetlines said it expects to announce a new startup date sometime in the second quarter. Investors will be watching the battle of the discount airlines between Canada Jetlines and WestJet's new Swoop unit. Both will try to lure passengers with their no-frill services and low-price fares. They say will start at about $100. That's less than a pair of Lululemon yoga pants. We asked Gadick about what he thought of Swoop, and he said, "We think Swoop is unnecessary because WestJet can serve the low-fare market with a special fare class. They don't need to go out and create a whole new airline to accomplish that."
Most of the data that's ever been created has been created in the past 2 years. You need a system for analyzing and making sense out of that data, and that's what we do. Where we, I think, really shine is we're a turnkey solution. We have hardware products that we can put in place. We have telemetry that we can put in place. It's all cloud-based, and we do it all for you.
Legend Power Systems is much less of a household name for investors, but has a much-needed technology that's starting to catch on among big-name companies. Legend Power's Harmonizer technology helps commercial building owners save money on energy by cutting down on so-called overvoltage. Companies such as Loblaw, Canadian Tire, and IKEA are using it at some of their locations. It's a good move given that more consumers and investors are paying attention to what corporations are doing to reduce energy and save money. We spoke with CEO Randy Buckamer about how the technology works.
What happens is the electrical source comes into an electrical room, and that powers all the different loads or different lights and things that there are in the building. So in that store, you'd have an electrical room. Our system goes in. It's about the size of a typical fridge freezer in a kitchen. And we connect to the grid, and we turn down like a big dimmer switch, or what we call tap down, the voltage that's coming in to a level that the building appliances work best at. That gap between what's coming in before and has been turned down by our system is the excess waste or over voltage, and we eliminate that and make sure that you're getting the voltage you need to run your buildings at the appropriate level.
Is your company a pioneer in this field, and are there others sort of nipping at your heels or who do something similar?
Yeah, in North America, no. What we've seen is transformers as an ability to tap down or reduce voltage in buildings has been around a long time. But the problem has been, specifically in North America, your voltage isn't constant. So what happens is if you manually adjust a transformer to reduce the voltage and your voltage environment changes, vis-a-vis your voltage goes either higher or lower, you can actually have your transformer had reduced your voltage goes down below a level that the equipment will work, and your building goes dark. So what we have, and it's a patent, and back to your original question, we're the only one that does it, is we have the ability to dynamically adjust the voltage, and we have patents, et cetera, technology that we have that will do that dynamically, right on the spot for making sure there's no adverse reactions or voltage issues when you're in your building.
You mentioned Loblaws, that's a client, Canadian Tire, Loblaws, yes. IKEA, yes. Some other ones. So let's say with IKEA, for example, yes. From before they use the harmonizer, your main product, to after, what are the savings like for them? Sure.
Well, let's stick with the original one just for a second. So if you take the Canadian Tire store in Lakeshore, their payback was 1.8 years. That means after the capital cost of the equipment, after the incentive provided by the utility, which is 25 to 30% of the capital cost of the project, when you add that all in, and the energy savings on a monthly or annual basis, it took 1.8 years for the product to be paid. So in that example, we have a 10-year warranty on our product. There's no cost once you buy it. So from 1.8 year payback on to 10 years, approximately 8 years, the product worked maintenance-free, and it has no cost to it.
Legend Power's stock has surged by about 130% since we spoke with the CEO back in early June. The shares have risen steadily over the past year, climbing more than 200%. Legend Power shares hit a high of 119 in early February. Legend Power has transformed from a startup to a growth stage with a proven product that has been installed in dozens of locations. Its business is mostly in Ontario, where electricity rates are high and companies are doing everything they can to cut hydro costs. The company also sees huge opportunities in the U.S. Northeast, where electricity costs are high as well, and governments are offering energy incentives for businesses to cut back on consumption. CEO Randy Buckamer told us recently that his team has an internal rallying cry. Here's what he said: $100 million in revenue in 2021, and we're focused on delivering that level of performance. We also have the goal of opening 5 additional U.S. regions in 2018 based on our proven Ontario success. Now, have we had a few companies whose shares have not done that? Well, of course we have. Nobody bats 1,000. Grande West Transportation is a stock that was surging higher when the company's former CEO, Will Traynor, was on the show back in early November. Shares of the Vancouver-based bus maker are down about 35% since then. Not a great chart for Grande West investors who may have bought near the top. But the company has made some management changes in recent weeks that it hopes will reverse that trend. Grande West has a new CEO in Jean-Marc Landry. He's the company's former vice president of sales. He took over in February. Traynor is now the president. The company positioned the management change as necessary as it, quote, shifts from a product-focused business to a stronger sales and customer development organization, unquote. We talked to Landry, who made the case that the company is gaining good traction in the U.S. He says 2018 is a pivotal year for GW as we ramp up our sales and manufacturing activity in the U.S. market. We started the year strong by realigning our leadership team, which will provide the expertise and the driving force necessary to successfully execute on our U.S. initiatives. That's our major area for future growth. From the heart of the financial district in downtown Toronto, that's our show for this week. I'm Mark Bunting. Be sure to subscribe to our YouTube channel so you don't miss an episode. And for stock ideas based on our curated research, subscribe to capitalideasresearch.com. A reminder that Capital Ideas' dynamic new website will be launching soon. It will focus on videos, stock research, a new podcast, a portfolio tracker, and many other invaluable investor resources. Thanks a lot for watching, and thanks for investing like a pro. We'll see you next time.